Hello everybody, Suntec we just released its full year numbers, and I think for this quarter, and for the full year actually, it's quite clear, right, that they have to match the rate hike impact on the DPU. So on a full year perspective, the DPU is actually up 2.5% to 8.88 cents. But you can see last year was the ravages of COVID and all the rental waivers and stuff, right? So this year the 8.88 cents of DPU for the full year, out of which 0.8 cents is actually return of capital. So the DPU from operations is actually down 6.7%, and it's very clear, right? It's because of the interest rate hikes. So if you look at this pictorially, this is the full year last year, and this year is up, but out of which 0.8 cents is from capital, right? So operating DPU really went down because of the rate hikes. I can see that the this also impacted the share price quite a fair bit. Last year it was 1.8 cents in the mid last year, and it went down to 1.37 cents, and at one stage went below 1.3. So people are really quite skeptical, maybe worried about the how much the impact will be. And of course, the impact of rising rates on cap rates, and therefore valuation falls and gearing busting and stuff. But overall, I think it's quite okay actually. I think the numbers came in better than expected. If you look at the cap rates last year, June 22 versus the cap rate of December 22, actually the first thing that you notice is the Singapore assets, be it office or retail or convention, are damn stable. So if anything, you look at the Singapore office cap rates, right, actually compressed by 5 basis points. But the rest of it all stable. Compare this one and this one, and then this one and this one is all the same. Even Australian assets also stable, 4.5 to 6.75%. So the weakness showed up only in the UK offices though. So in the cap rates went up by roughly 20 basis points, 426 to 438 last year, and 443 to 466 this year. So higher cap rates, lower asset prices. So you can see this is happening. But I think this is better than what the market expected. So overall, it's not a big damage as compared to some other REITs, especially those with offices in the US. Those stuff saw quite a fair bit of impact. So actually, I think the numbers are better than expected actually. But if you are a holder of a REIT with assets in Singapore, I think you should be quite relieved if you look at these numbers. It's still very, very stable. Good job, Singapore. On the financial end, the numbers are a bit better, I think. Leverage ratio have improved from 43.7 to 42.4%. But you can see the all-in financing costs have jumped up by 60 basis points, right, from 235 to 294. But that's because they locked in more of the borrowings on fixed rate. So it has improved from 53% to 66%, albeit the impact on the all-in financing cost, right? But you gotta do it anyway. You can see the impact on the ICR all went down from 2.6 to 2.4 times. So by and large, I think the balance sheet is still quite stretched. But the manager, I think, is quite frank. So this is the very, very clear view on the impact. So operating performance will improve, largely because of the improvement in retail in Suntec City Mall, and also improved mall MICE activities in Suntec City Convention Centre. The office assets should be quite stable, be it Singapore and UK because of the long lease over there. Australia might see some weakness though. Of course, there's FX effects on itself, right? So the bottom line will be impacted by rising rates, FX effects, and of course, a higher utility costs. But that stuff seems to be softening a bit. So that's good news, I guess. But all in, the earnings will go down because this is the math, right? You can't escape from it. I think the strategy is still the same as from the last few quarters though. I think the manager is making quite clear they're looking at potential divestment of mature assets. So for me, I think the potential assets would be number one, Singapore Suntec City offices, which are trading quite a premium to book. So that should be quite a logical asset to divest. I think some of the mature Australian offices might be ripe for divestment as well. So once you can do it at a premium to book, I think the balance sheet will be lightened up quite a fair bit. So I think this is the main focus for this guy going forward for the next 1 year actually. So I'm not a shareholder, I'm not a unit holder as of yet, but it's always an interesting and well managed REIT. I think in my opinion. So well, let's see if they can manage to do some reshuffling to lighten up the impact of the balance sheet. So, well, interesting times ahead for 2023.